Everyone wants to buy a dream home. Most of us rely on loan from banks to buy a house. The monthly installment or the EMI should be planned in such a way that it is covered well after meeting the monthly expenses and saving. An equated monthly installment or the EMI, as we all know it, is a fixed amount of monthly installment which is required to be paid by the borrower to the lender at a specified date of the month. An EMI includes two components, principal repayment component and interest component. This is calculated such that the loan is fully paid off after the completion of the tenure. EMIs have low portion of principal payment and high interest component during initial years of loan tenure. The principal component of the EMI keeps increasing while the interest component keeps declining as the loan matures. Let's understand how to calculate EMI on home loan in Excel with an example. Suppose we have taken a loan of rupees 10 lakhs from a bank. The rate of interest is 8%. Loan tenure is 20 years. Now, how do we calculate the EMI on this home loan? In Excel, we should go to formulas. Then under financial formulas, we should look for the payment function, the PMT function. Here we go. Here we need 5 inputs. Let's understand each of them one by one. The rate is the interest rate charged by the bank. In our example, the interest rate is 8% per annum. So we'll select 8% and then divide it by 12 because we want to calculate the monthly EMI. N per is the total number of payments on the loan. In this example, we have a loan tenure of 20 years, which means 240 EMIs. So we select 20 and then multiply it by 12. Present value is the present value of the loan amount, which is 10 lakhs in this example. Future value is the future value of the loan. In our example, the loan needs to be paid up fully, so the future value is 0. Type is 1 if the loan or if the EMI is paid at the beginning of the period, and 0 if it is paid at the end of the period. So usually banks charge EMIs at the end of the month. So let's put 0. So what do we get? We get an EMI of rupees 8,364 rupees. Let's test this with the help of a simple table. So let's make the first column as month, second column as opening balance, third one as the EMI payment, then interest component on EMI payment, principal component, and the closing balance. The opening balance in this case is rupees 10 lakhs. EMI amount is 8364. So let's select and freeze 8364 because this amount is going to remain fixed. Interest component is your opening outstanding multiplied by the interest rate divided by 12 because we are calculating a monthly interest component. Let's freeze D9. So the principal component in this EMI is 8364 minus 6667, which is 1697. The closing balance for this loan after the end of 1 month is 9,98,302 rupees, which is the opening balance for the next year. The EMI amount remains same. Interest component gets calculated. Principal component is the balance amount, and the closing balance reduces further. So now let's double click on this selected cells and we get the full table. Now, so we see that at the end of the 240th month, the principal component outstanding is 0. That means the loan has been fully paid. When we see the table, we see that the interest component keeps on reducing each month while the principal component keeps increasing. Towards the end of the loan tenure, the interest component forms a small portion of the EMI amount while the principal component forms the maximum portion. That's it from my side. Hope you enjoyed this session. Thank you.